Welcome back. It is time for the Word on Wall Street. Top investors watching your money. Joining me right now is Banríon Capital Management founder and president Shana Sissel. And with us all morning long, Adam Johnson. Great to see you, Shana. Thanks for joining the conversation. Adam, kicking things off with you. A look at futures this morning ahead of a big week of retail earnings and the April retail sales report out in about an hour. Economists are expecting a monthly increase of 0.8%. We saw Home Depot report a revenue miss. They also took their guidance down, cutting the full-year sales forecast. The stock is down this morning by 3.5%. Target, TJX, Walmart also will be coming out with earnings this week. Adam, what are you expecting from the retail sector?
Well, I'll tell you what, optimists like me, Maria, need a good number today, and I'll tell you why. Retail sales in January rose 3%. Last month, or I should say in March, they fell 1%. So from up 3 to down 1. So we need that 0.8 gain this morning. That's important. And I think that also gets to the narrative of what's been happening in this economy. If it weren't for the U.S. consumer, we'd be in a very different place. 2/3 of GDP in this country is consumer driven. So again, we need to see some strong numbers on the retail front this morning. As for that Home Depot print, which by the way is the whole reason why the Dow is down about 75, 80 points right now. I don't really take Home Depot as a proxy for the economy, and I'll tell you why. For 2 years, we were all locked up at home. If you haven't spent the money that you needed to spend on your home by now, you probably aren't going to, or you don't care about your home. So the fact that the Home Depot numbers were a little bit soft actually kind of makes perfect sense to me. I think that money's been spent. What I want to see is confirmation that Americans are out there spending on experiences, which has been certainly a theme, and not doing so on their credit cards, because that would be a little bit of a flag for me. So big number at 8:30. We're looking for up 0.8%, Maria.
Yeah, but I'm looking at all of the debt on corporate balance sheets. You're talking about the consumer. Shana, 7 companies filed for bankruptcy in the last 24 to 48 hours. That includes Vice Media, Envision Healthcare, both filing for protection in just the last 24 hours, 7 total in 48 hours, because they're feeling the crunch from high interest rates. And I just want to say that this is the largest number of filings on record during a 2-day period since at least 2008. That's according to Bloomberg and their data on companies with at least $50 million in liabilities. This is exactly the issue that Macro Maven's president Stephanie Pomboy pointed out on this program back in March on what's causing the financial stress that we're all feeling. Watch this.
We don't have a liquidity issue. We have a credit issue. Everyone's analysis of this SVB has been to focus on its liquidity problems. But at heart, the problem was that their clients, the companies that they both lent to and held deposits from, were marginal companies that couldn't survive in a high interest rate environment. They have yet to figure out that they're going to get smacked in the head with a 2x4 as these bankruptcies start to accelerate.
Shana, companies across a multitude of sectors are struggling with higher interest rates. We just spoke to Bob Nardelli, and he told me as well that many of his companies are actually facing, they thought that they had rates of 2 to 4%. They're all the way up to 18% right now as their debt rolls over. Is this going to get worse?
It very well could. I mean, this is the next logical domino to fall after you see stress in the banking system. If you think about the banks that have seen the most stress, they tend to be the banks that are the most likely lenders to some of the companies in this subprime or high yield environment. SVB, Signature Bank, First Republic were all major lenders to the startup economy, which we've seen what happens there. There is tightening credit conditions. The debt ceiling debate only brings that even more stress into the system, as one of the dominoes that could fall with that is to see the credit rating of U.S. Treasuries be downgraded. And if that happens, then interest rates are going to go up even more. So there's clear stress in the system. As Adam pointed out, that consumers not seeing it per se, I am not nearly as optimistic. I actually do think you're going to continue to see increasing in credit card purchases and increasing debt. We're seeing consumer defaults rising. So there's a lot of pressure here on the financial system as a result of the rapid increase in rates and the monetary policy of the Federal Reserve.
Yeah, let me be clear, because Bob Nardelli told me that he has companies that he's invested in where interest payments went from $2 to $3 million to $18 million. That is an enormous change, and that is going to command much more of the company's funds. And as a result, we're seeing these bankruptcies increase. Sure, Shana, you say you're much less optimistic than Adam. Do you think we're going to see a recession later this year then?
I absolutely do. The Federal Reserve told us completely transparently that they expect to push us into a recession. The Fed is one of those organizations you just don't fight, and they've made it clear that a recession is something that they envision will happen as a result of their tightening policy.
Yeah.
I don't know how anyone could disagree that a recession is coming. It's taking a long time because there's a lot of excess in the system. There's a lot of excess cash in the system. There's a lot of excess liquidity in the system. And we've been preparing for this recession for about 12 months. So to some extent, we've been able to protect ourselves, but that is starting to run thin. You are seeing increased bankruptcies.
That's what happens when you have, pardon me, that's what happens when you have 0% interest rates for 15 years. Exactly. And then you hike it all the way up to 5% in an 11-month period. Adam, I know you're bullish. Real quick, do you worry that 7 companies have gone bankrupt in the last 48 hours?
No. I think that is. I think it's a relevant data point, but no, that does not concern me. I think that's cherry picking the news. These aren't any surprises here. Vice Media, that's not a surprise. Some of these other companies, not a surprise. I was speaking with a senior partner at Proskauer who runs bankruptcies, and they staffed up ahead of what they thought was going to be a surge. The surge hasn't materialized. So there are isolated stories out there. Yes, higher rates are squeezing everybody. But do I read into 7 bankruptcies this morning? No, I think it's a soundbite.
Yeah, I think that TPG at its peak valued Vice Media at $5.7 billion back in the day when TPG was investing there. Shana, great to see you. Adam, always a pleasure. You're sticking with us all morning, and we're grateful. Great word on Wall Street, guys. Thank you. Quick break, and then House Speaker Kevin McCarthy says there's been no movement on the debt ceiling. We just spoke with the chairman of the Financial Services Committee. Janet Yellen is warning again the U.S. could run out of money in just a few weeks. What it means for your wallet on the other side of this.